Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Jon Maier, Chief Investment Officer of Global X. We're going to discuss ways to capitalize on growth and components of innovation and why diversification is key in the market environment. Jon, it is great to see you. Welcome back to Trade Talks in studio.
Thanks for having me. It's awesome to be here.
You got it. Let's start with the macro first. The banking crisis that we saw in March, for as long as it lasted, did it help the Fed do some of its job?
Well, I mean, it effectively acted as a tightening mechanism. Obviously, nobody wanted the banking system to have a liquidity crisis, but the Treasury and the Fed certainly stepped in and they restored confidence in the system. But what it did do is tighten credit standards, and we are seeing that filter down. So ultimately, I believe that the Fed will be going slower than they would have been. Will we see another 25 basis points at the next meeting? Maybe. Maybe not. Are they going to hang out at this 5% rate for a while? I think that is the more likely scenario. You know, what is Jay Powell? Does Jay Powell want to be known as Arthur Burns or Paul Volcker? Mm-hmm. And obviously the latter. So I think, yeah, it's acted as a tightening mechanism for sure.
How has the banking sector impacted credit, and what does that imply for inflation?
Well, credit standards are certainly tighter, without a doubt. It's harder to access capital. Companies are, higher grade companies certainly will still have access to capital. They probably refinanced at lower rates previously, so they don't necessarily have to. But without a doubt, this is going to filter down into, slowing growth. We are seeing unemployment rise in many different areas. And what's pretty interesting is that every time a company announces a mass layoff, the stock price goes up. And that's because investors are looking forward and they're looking for efficiencies. And when they see companies are taking action, that's like, well, they're trying to manage their margins going forward. So I think it's, certainly the credit standards tightening is going to hurt the economy short term, but longer term, I think this is kind of what has to be done.
Right. Well, I mean, we haven't gone through cycles in 12, 14 years now. Yeah. We're actually going through economic cycles. And speaking of jobs, the equity market is closed tomorrow for Good Friday, but government offices are open. So we're going to get that key non-farm payrolls report tomorrow. It only happens like every 2-4 years. What does a surprise to the downside mean?
Well, for a while now, bad news has been good for the market. Yesterday, the JOLT numbers came out, or the ADP numbers came out, and that the market didn't do as well. So it's starting to be that bad news perhaps is bad news. And the market is saying, perhaps this is not going to be a soft landing. It's going to be a little bit harder of a landing. And the market's been looking forward towards the end. Perhaps it's further out now. And I do think unemployment's going to rise. I do think the numbers are going to be weaker tomorrow. And obviously the market's not open, but it will react on Monday. Well, maybe layoffs are going to, maybe the Fed's work is happening.
Right.
The lag effect is actually playing into it, but it's going to take a little longer for this recovery.
How are you managing portfolios and capitalizing on the shift that we've seen back to growth?
Yeah, it's been a great year for growth for sure. And what we are seeing is that companies that can improve their efficiencies are benefiting, but you're also seeing a trickle down effect, and companies that are not as large and don't have as strong of a cash flows are still done pretty well this year. So what I'm seeing is that, and how we're positioning portfolios, is you need a combination of quality growth, mm-hmm. as well as focusing on innovation. And we're looking for tailwinds. Some of the tailwinds that we're looking for include, whether it be components of the infrastructure package that affect the clean energy world, cybersecurity, which is certainly on people's mind because of whether it be the war in Ukraine, and companies need to protect their data. Governments are mandating that companies, software companies, provide protection. So we're looking for those tailwinds. And if you look at cybersecurity companies, those companies are actually, their debt to equity ratios are pretty good, especially in comparison to the S&P 500. So they're not in bad shape, and their consensus forecasts are revenue growth continues to rise, so that's a positive.
So while you continue to focus on quality growth, you're also looking at what's next. So what themes look attractive when you think of next gen?
Well, we're all talking about AI, mm-hmm. and it's an exciting area. We're seeing such a tremendous amount of growth. Is this like a short-term buzz or a long-term something? And I think it's the latter. It's going to go fits and starts, but if you look at all the companies that are impacted by AI, first of all, the larger companies like Microsoft and Apple and companies that have access to large amounts of data, that's what these AI companies, you need this data for, to compute
Right.
for AI. So that's really important. Then those other companies that are impacted, NVIDIA, for example, they produce the GPUs that are going to be in short demand. There's going to be 35% annualized growth over the next 6-7 years because of the growth in this area. I use ChatGPT just for little things like checking grammar, getting started on writing a report. Obviously not writing my report,
Right.
but one day it may write a report, and probably can in certain instances, and it increase efficiencies. And I think that's what the market is looking for in many different companies. How can we increase efficiency? You're looking at the CapEx cycle, which is really strong. That's one bright spot in the earnings report. CapEx has been strong for many S&P 500 companies because you think about starting back to the China tariffs, and companies need to reinvest in themselves, not focus purely on China, reshoring, friendly shoring, and because of the labor shortages, improved efficiencies. So while AI potentially could take some jobs away, it's going to add a lot of other jobs as well.
Right, right. And to wrap up here, why is diversification key with ETFs, and where are you seeing the flows?
Well, the flows for diversification, if you think about an ETF, this kind of unique structure, whether it be a broad-based index or a more narrowly focused index like, say, cloud computing or cybersecurity, you're buying a collection of companies. You're not picking that 1, 2, or 3 winners, or avoiding those losers. You're buying a group of companies that fall into the index because of the index methodology. So it's broad-based diversification or more narrowly focused diversification. And of course, the tax efficiencies. Where you are seeing lots of flows is the fixed income area. Treasury rates are up, there's alternatives, and the correlations between equities and fixed income have broken, which is a positive. So you can have a more balanced portfolio right now. You can get a 4.5% yield depending on where you are on the maturity scale. So that's, you're seeing a tremendous amount of flows into fixed income.
All right, John, great to catch up as always. Thanks for joining us on
Thank you.
TradeTalks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.